Hello everyone. Today we're going to discuss about the inflation and unemployment relationship. We'll see how the inflation and unemployment trade-off works, and can inflation and unemployment decrease or decline together. So the main points of the presentation are going to be the inflation and unemployment relationship, how inflation and unemployment trade-off works, at least in the short term, wherein why we'll discuss why inflation usually goes higher as unemployment declines. Also, we'll see if inflation and unemployment rate can both decline together or decrease together. First, let's see how money is created in the credit-based monetary setup that we are in. In this system, the person goes to the bank to get a loan. The bank asks for a collateral, which the person offers, can be his asset, factory, inventory, anything. In lieu of this collateral, the bank grants him a loan. And that's it. Voila! Money is created in the system because, as the name suggests, in this system, credit is money. Now, let's see how this money or credit generated in the system is inflationary, at least in the short term. So, with this credit, the person sets up a factory, has built an infrastructure to in turn build products later on. Also, using that money, he invests some of that money in real estate, because of which the prices of real estate rise. Also, he gives out salaries to his employees or to his workers who build that factory, employees who start working in that factory. That means that till now, once he does all this, he sets up the factory, gives salaries to people who build that factory or who starts working in that factory, invests in real estate, all these steps have yet to contribute to the increase in supply of goods and services, while the money has already been created and distributed in the system. So there is demand because of that, but the supply has yet to come, which means there is inflation in the system, which goes up. Of course, after some time, after a lag, supply will come, which will bring down the inflation. And that is why growth and employment, increase in employment opportunities, is inflationary in the economy, at least in the short term. Now let's see how money grows in the economy in the system. So the person who took out the credit from the bank and invested in his factory, good for him, his business grows. Now he goes to the bank again, he sees good demand and uh, good business opportunities for the future. So he goes to the bank again asking for a bigger loan, which the bank is happy to give since he has now a bigger collateral to offer. And so the bank gives him a bigger loan. And voila, as simple as that, more money is created in the economy. Now, let's see another scenario. In this, we have seen how inflation increases, at least in the short term, with increase in growth and employment opportunities. Now, can inflation rate, I'm speaking about just inflation rate, can it decline with increase in employment opportunities? Or can it decline, in other words, without any reduction in overall demand, in aggregate demand in the economy? Can inflation rate decline in that? Let's see a scenario. In this scenario, the person has invested in the factories, started paying his employees, and the factory has started producing some products. Let's say there is some technological marvel or some machine he gets which enhances the productivity dramatically of his employees. Using that, using the increased productivity, now his employees and his factory can produce two products for the same input because of these technological machinery interventions. That means there is more supply to offer. So with the same amount of money or same amount of inputs, he can create more supply. So actually the credit required to produce the same amount of goods as earlier based upon the demand, since the demand is still the same, will be lower. So the credit requirement is lower. And hence, since the credit requirement is lower, the inflation, the aggregate inflation would actually fall in this scenario. Let's take a second scenario for this. In this case, let's say the country hits a jackpot. He gets a critical commodity like oil in huge quantity, discovers that in huge quantity. That would mean the supply of this critical commodity increases, its price declines, so the input cost would decline, and that in turn would again mean, since his input cost has declined, the credit requirement to produce the same amount of goods have declined. So unlike previously that we saw in the slides, when the credit used to grow, if he wanted to grow his business, in this case the credit growth required is not that much. And so since the credit requirement has declined, so has the inflation. Now let's see how unemployment can reduce based on these scenarios. So as we have seen, the credit requirement to produce the same amount of goods have declined, either because of the productivity enhancements or because of supply increase of critical commodity. That means reduction in the input costs, and hence the credit requirements have declined. This person can can divert some of the credit which is not required any longer, can divert some of that, or can add a little bit more, can get a little bit more credit from the bank and add to this credit and open a second factory. That means he would have to give employment to more people. And that is how the employment opportunities in the economy are increasing even as the inflation rate has declined. So however, it's important to note that we are talking about a decline in inflation rate. So that is, let's say the inflation rate was 4% to begin with, it declines to 3%. But if someone was to say that can inflation actually fall close to zero or in negative territory, which means actually deflation, for that to happen, it really means that in fact the credit in the economy comes down. In all those cases we saw previously, the employment opportunities were increasing on the back of credit remaining same or slightly increasing. If this were to happen, then the credit or the money supply in the economy were to decline or reduce from the current levels. So before going forward with it, let's quickly see how money is actually destroyed in the economy. One of the scenarios in how money can be destroyed in the economy is if a person who has taken the loan from the bank goes to the bank and he returns the loan back. That means he may not see good demand in the future for his business, or he has discovered some alternate source of funding. Whatever be the reason, he goes to the bank and returns the loan, and that's it. Money is destroyed as simply as it was created. Now, in our scenario, wherein we think how inflation can actually be in the negative territory or deflationary area. In this scenario, the person would go to the bank, return the previous loan, and go to the bank and in lieu of the collateral, this time take a lesser credit than what he took the last time. So in effect, the money supply in the economy has reduced. Now, a decline in credit supply would mean that the person, unlike previously, is not opening a new factory producing another category of goods. Unlike previously, this factory would have given more employment opportunities. Hence, in this case, the employment opportunities are not increasing. Now, with a reduced credit to produce the same amount of goods means that the salaries of his employees come down. Reduced salaries of the employees would translate into lower demand from these people. A lower demand would signal the factories in turn to cut down their supply. A reduction in supply would mean the threat of economic recession. And as in an economic recession happens, the unemployment goes up. So, in effect, it can happen that inflation rate goes down or remains steady even as unemployment rate declines in the economy. However, a fall in inflation that is going to negative or close to zero would mean deflation or overall credit destruction. A deflationary scenario means lesser business opportunities because of low demand, leading to low supply of goods. And this would mean recession in the economy, and that would affect employment opportunities as unemployment would increase again. So in conclusion, inflation rate usually increases with decline in unemployment rate, at least in the short term, as we saw. Sometimes because of a rise in productivity, dramatic rise in productivity, or a sudden supply increase of a critical commodity like oil, or there can be a very large slack in the factors of production like labor. Let's say the economy is coming out of a deep recession, which means a very big slack in the factors of production like labor in the economy. Inflation rate may remain steady or it can come down somewhat, as we saw. Even as the unemployment rate declines, that means the employment opportunities are increasing. However, a negative inflation rate or a deflation is not possible with a declining unemployment rate. As a negative inflation rate means a reduction in credit supply, which leads to lower salaries, which in turn affects the demand, leads to lower demand and lower supply. Thus, it causes recession and an increase in unemployment in the economy. So thank you very much for watching this presentation. Do subscribe if you like such content and comment in case you have any questions. Thanks a lot.